The Indian rupee is in a crisis, and so is the Indian market. It is not just falling because the US dollar is strong. It is not just falling because of one bad month in the markets. And it is not just a headline for traders, exporters, or the Reserve Bank of India. The rupee problem is now connected to oil, gold, foreign investors, artificial intelligence, household budgets, and the quiet financial stress inside India's middle class. In financial year 2026, the rupee has seen one of its sharpest annual falls in more than a decade. It has touched record lows near 96 to 97 rupees per US dollar. That number sounds technical, but behind it is a much bigger story. A weak rupee makes imported fuel more expensive. It makes electronics more expensive. It makes foreign education more expensive. It makes medicines, fertilizers, edible oils, and travel more expensive. And when India imports so much of what it consumes, the exchange rate quietly enters almost every household budget. The uncomfortable part is this. The rupee is not facing one problem. It is facing several problems at the same time. India's oil import bill is rising. Foreign investors are selling Indian stocks at a historic pace. Global capital is moving toward artificial intelligence hardware markets like Taiwan, South Korea, and Japan. Gold imports are draining dollars. The Reserve Bank of India is trying to manage the fall, not magically stop it. This is not a 1991-style crisis. India is not running out of foreign exchange reserves. The country still has a large reserve buffer, a diversified economy, strong services exports, and huge remittance inflows. But it is also not a small problem. It is a warning signal. And to understand that warning, we have to start at the petrol pump. India's biggest currency vulnerability is oil. India imports around 85 to 90% of its crude oil requirement. Domestic production is tiny compared to consumption. India consumes more than 5 million barrels per day, while producing only around 0.6 million barrels per day. That means every time crude oil becomes expensive, India needs more US dollars. More dollars for crude, more dollars for gas, more dollars for transport, more dollars for fertilizers, more dollars for the entire energy chain. This is why oil is not just an energy issue for India. It is a currency issue. The report estimates that every 10 US dollar increase in crude oil prices can add around 12 to 16 billion US dollars to India's annual import bill. It can also widen the current account deficit by roughly 0.4 to 0.5% of gross domestic product. That is the core mechanism. When oil prices rise, India's import bill rises. When the import bill rises, India needs more dollars. When dollar demand rises, the rupee comes under pressure. And this is not just theory. Research cited in the report found an extremely strong relationship between Brent crude oil prices and the rupee-dollar exchange rate over the 2015 to 20 and 25 period. The analysis found that crude oil alone explained about 84% of the variation in the rupee-dollar exchange rate. In simple terms, oil prices have been one of the strongest forces behind the rupee's movement. That is why the rupee can look weak even when India's growth story looks strong. A country can grow fast and still have a weak currency if that growth depends heavily on imported energy, imported electronics, imported gold, imported fertilizers, and imported machinery. Growth creates demand, but if that demand creates dollar outflows, the currency feels the pressure. This is the contradiction at the heart of India's rupee problem. India is not collapsing. India is growing. But a part of that growth is import-heavy, and import-heavy growth keeps asking for dollars. The oil shock becomes even more dangerous when geopolitics enters the picture. The report discusses the Iran war and disruption around the Strait of Hormuz as key risks. A large share of India's crude and liquefied natural gas exposure is linked to that region. If shipping is disrupted, insurance costs rise. If tankers slow down, prices rise. If global crude spikes, India's import bill expands quickly. And when Brent crude rises from below 70 US dollars per barrel to above 100 US dollars per barrel, the effect is not limited to oil companies. It reaches transport, it reaches food, it reaches electricity, it reaches airlines, It reaches paints, chemicals, tires, and consumer goods. Eventually, it reaches the household. This is where the rupee story becomes a middle-class story. A weak rupee does not announce itself with a single bill. It spreads quietly. Petrol becomes expensive. Diesel becomes expensive. Transport costs rise. Food distribution becomes costlier. Imported cooking oils become costlier. Electronics become costlier. Medicines using imported ingredients become costlier. Foreign education becomes costlier. International travel becomes costlier. The report estimates that a 5.5% rupee slide can erode around 2,500 to 3,500 rupees of monthly purchasing power for a family with a 50,000 rupee monthly budget. For a family spending around 1 lakh rupees per month, the same basket of goods may effectively feel like 1.05 lakh to 1.07 lakh rupees. That is not a dramatic collapse. It is a slow squeeze, and slow squeezes are often harder to notice until they become permanent. Many middle-class households already live with very little margin for error. Salaries come in, but rent, school fees, car loans, home loans, credit card bills, phone EMIs, medical costs, and daily expenses take away most of it before the month really begins. When fuel and food rise, the household adjusts. It buys smaller packs. It postpones purchases. It cuts travel. It delays upgrades. It dips into savings. It uses more credit. It sells gold. It pauses investments. This is not poverty in the traditional sense. It is financial fragility. The household looks stable from outside, but one job loss, one medical emergency, one bad business month, or one loan reset can change the entire picture. That is why the rupee matters to ordinary people. Because the currency is not just a trading screen, it is hidden inside the monthly budget. But oil is only the first layer. The second layer is foreign investor selling. Foreign institutional investors, or FIIs, have been selling Indian equities at a remarkable pace. According to the report, FII outflows in the first 4 months of 2026 reached roughly 1.92 to 2.41 lakh crore rupees, or around 20.6 to 29 billion US dollars. That means foreign investors sold more in just the first few months of 2026 than they did in all of 2025. Foreign ownership in Indian equities has also fallen to its lowest level in roughly 15 to 16 years. This matters because foreign investors do not just affect stock prices, they also affect the currency. When foreign investors sell Indian stocks, they receive rupees. To take money out, they convert those rupees into US dollars. That creates more dollar demand. More dollar demand puts more pressure on the rupee. So the stock market and the currency market start feeding into each other. A falling rupee makes Indian returns look weaker in dollar terms. That makes foreign investors more cautious. If they sell more, that puts more pressure on the rupee, and the cycle continues. The report gives a simple example. If the Nifty is flat in rupee terms, but the rupee falls from around 85 to more than 96 per US dollar, a foreign investor may still be sitting on a major loss in dollar terms. That changes the investment calculation. For an Indian investor, the market may look sideways. For a foreign investor, the same market may look like a currency-adjusted loss. This is where the AI story enters. At first, artificial intelligence may not sound connected to the Indian rupee. But in 2026, global capital is increasingly chasing the countries and companies that sit directly inside the AI hardware supply chain. Taiwan has TSMC, South Korea has Samsung and SK Hynix. Japan has semiconductor equipment and advanced manufacturing exposure. These markets are not just talking about AI, they are selling into the AI infrastructure boom. We argue that global money is rotating towards semiconductor-heavy markets because investors believe the next earnings explosion will happen there. And India has a problem here. India has software talent. India has IT services. India has digital adoption. India has data center investment. But India's listed market is not deeply exposed to the AI hardware cycle. It is still dominated by banks, consumption, industrials, financial services, and IT services. These sectors can be strong, but they are not the same as semiconductors, memory chips, advanced packaging, and AI infrastructure hardware. That distinction matters to global investors. Korea and Taiwan together are expected to contribute a huge share of Asia-Pacific earnings growth, while India's contribution is tiny by comparison. Global funds hold enormous exposure to companies like Samsung, TSMC, and SK Hynix. In contrast, India is being treated less like an AI winner and more like a funding source for the AI trade elsewhere. That is a harsh phrase, but it captures the market logic. India may be a good long-term economy, but global capital is relative. Money moves to where investors believe returns will be faster, cleaner, and more directly tied to the next big earnings cycle. Right now, that cycle is AI hardware, and India is not yet at the center of it. This does not mean India has no AI story. Big technology companies are investing in AI infrastructure and data centers in India. India also has a huge developer base and a large digital economy, but the report's point is sharper. If India's role in the AI boom is mostly as a back-office, services provider, or data center market, that may not be enough to attract the same kind of global equity flows that semiconductor economies are receiving. Data centers consume power and capital. Semiconductors capture pricing power and earnings. That difference is one reason foreign investors may be reallocating away from India and toward North Asian markets. There's also the U.S. interest rate angle. When U.S. Treasury yields are around 4.3 to 4.5%, global investors can earn a relatively attractive return in U.S. dollars without taking emerging market equity risk. If an investor can earn a dollar return in the United States, why take currency risk, valuation risk, oil risk, and political risk in an emerging market unless the growth upside is clearly superior? That is the question India has to answer. And in 2026, foreign investors appear less convinced than before. Indian equities have also looked expensive compared to many alternatives. High valuations are manageable when earnings are strong and currency is stable. But when the rupee is falling, oil is rising, and global capital is chasing AI hardware elsewhere, expensive valuations become harder to defend. So the FII selling is not just panic. It is a mix of cyclical pressure and structural rotation. Higher U.S. yields are cyclical. Risk-off sentiment is cyclical. But AI capital rotation may be structural, and that makes the problem more serious. Now comes the Reserve Bank of India. Many people think the RBI can simply stop the rupee from falling. But that is not how it works. The RBI can intervene. It can sell U.S. dollars. It can reduce volatility. It can slow panic. It can discourage speculation. It can make the fall smoother. But it cannot permanently defeat structural pressure if the underlying dollar demand keeps rising. The report describes the RBI as managing a controlled fall, not defending a fixed level. That distinction is important. India does not have a fixed exchange rate. The RBI usually intervenes to prevent disorderly volatility, not to promise that the rupee will never cross a certain number. In May 2026, the RBI reportedly sold billions of US dollars in the market to support the rupee. It used state-run banks, spot market intervention, offshore market tools, and restrictions on bank foreign exchange positions. These actions can work in the short term. They can scare speculators, they can produce sharp rupee recoveries, they can buy time, but they cannot erase the oil bill. They cannot stop FII outflows forever. They cannot change India's AI exposure overnight. They cannot make gold imports disappear. And they cannot make a current account deficit vanish by force. There is another constraint. The RBI's forward liabilities have grown significantly. The report notes that its net short dollar position in the forward market reached about 103 billion US dollars by the end of March 2026. That matters because headline foreign exchange reserves do not tell the full story. India still has large reserves, such as around 690 billion US dollars in May 2026. That is a powerful buffer. It is one reason this is not 1991. But reserves had fallen from a peak of around $728 billion earlier in the year. That is a drawdown of roughly $38 billion in about 3 months. And when forward obligations are considered, the effective comfort level becomes lower than the headline number suggests. Still, India is not in a foreign exchange emergency. That nuance matters. The country has reserves. It has services exports. It has remittances. It has a large domestic investor base. It has policy tools. But the direction of pressure is real, and the RBI's job becomes less about reversing the trend and more about preventing panic. This brings us to the balance of payments. The balance of payments is basically the country's external account. It tracks how money enters and leaves India through trade, services, investments, remittances, and capital flows. India's external position is under pressure on both sides. On the current account side, the merchandise trade deficit is widening because imports are expensive. Oil, gold, gas, fertilizers, electronics, and other imports create dollar demand. On the capital account side, foreign investors are selling equities, and foreign direct investment has not been strong enough to fully offset the pressure. India's current account deficit could move from around 1 to 1.3% of gross domestic product toward 2 to 2.3% if oil prices remain elevated. That is still not as severe as 2013, when the current account deficit reached around 4.8% of gross domestic product. But the direction is uncomfortable. The danger is not one single number. The danger is convergence, oil pressure, gold imports, FII outflows, higher U.S. yields, AI capital rotation, geopolitical shipping costs, possible stress on Gulf remittances. Each of these may be manageable alone. Together, they create a much harder problem. Gold is a particularly interesting part of the story. In India, gold is not just a commodity. It is culture, savings, security, inheritance, status, and insurance. But in a currency stress episode, gold becomes both a symptom and a cause. India's gold imports reached a record $71.98 billion in financial year 2026. Interestingly, the volume of gold imported actually fell. The import bill rose because gold prices surged. That means Indians were not necessarily importing much more gold by weight, they were paying much more for it. Investment demand for gold also rose sharply, while jewelry demand weakened. That shift matters. When people buy gold for jewelry, it can be cultural consumption. When people buy gold for investment, it can be a fear signal. It means households are looking for protection. But gold creates a paradox. A weak rupee makes people want gold. But importing gold requires dollars. More dollar demand weakens the rupee further. That weakness can make people want even more gold. It becomes a loop. The government can raise import duties or ask people to reduce gold purchases, but such measures may treat the symptom rather than the cause. If people are buying gold because they are worried about inflation, currency weakness, or financial security, then scolding them for buying gold does not fix the underlying anxiety. It may even increase it. There is also the risk of smuggling. Historically, when gold import duties rise too much, demand does not always disappear. Some of it simply moves into informal channels. So gold becomes both a household hedge and a national dollar drain. Another common debate is the comparison between the Indian rupee, the Pakistani rupee, and the Bangladeshi taka. Indian rupee weakened against both the Pakistani rupee and the Bangladeshi taka over the past year. On the surface, this sounds alarming, but the comparison is misleading. Pakistan and Bangladesh operate under different policy conditions, different import controls, different capital account structures, and different reserve pressures. Pakistan has been under IMF programs and has used strict controls to compress imports. A currency can appear more stable when demand is suppressed by policy. India's rupee is more market-determined. India has a larger, more open, more complex economy. It faces heavy oil demand, large capital flows, and active global investor participation. So a short-term currency comparison does not prove that Pakistan or Bangladesh are economically stronger than India. It only shows that currencies move under different regimes and different constraints. The long-term picture is also different. Over the past decade, the Indian rupee had strengthened significantly against the Pakistani rupee before the recent correction. So the real lesson is not that India is suddenly weaker than its neighbors. The real lesson is that regional currency comparisons can become political theater if they ignore inflation, reserves, import controls, capital flows, and policy regimes. Now, who benefits from a weak rupee? Because there are winners. IT exporters benefit because they earn revenue in foreign currency and report profits in rupees. A weaker rupee can boost margins for companies like TCS, Infosys, Wipro, and HCL. Pharma exporters can benefit because a large share of their revenue comes from regulated markets like the United States and Europe. Textile exporters can become more competitive. Families receiving remittances from abroad get more rupees for the same dollar income. Gold holders also benefit because gold prices in rupee terms rise when global gold rises and the rupee weakens. So the weak rupee story is not one-sided. But the winners are concentrated. The losers are broad. Most Indian households are not exporters. They are consumers of imported fuel, imported electronics, imported edible oil, imported components, imported medicines, or import-linked goods. Most households do not earn in dollars. They spend in rupees. And when the rupee falls, their rupees buy less of the global economy. This is why the middle class squeeze matters. It is not always visible in headline inflation. Consumer price inflation may look manageable for a while, but household inflation can feel much higher when the items that matter to a family are rising faster than the index. School fees may rise, medical costs may rise, EMIs may rise, fuel may rise, food may rise, rent may rise, and salary may not rise at the same speed. There are signs of behavioral change, people buying smaller FMCG packs, families shifting from bulk purchases to daily cash flow management, households reconsidering LPG use, families dipping into savings or liquidating gold. These are not signs of a dramatic crash. They are signs of reduced financial breathing room. That is often how economic stress appears in the middle class, not as one dramatic event, but as 1,000 small adjustments. There's also a stock market connection. When the rupee falls, foreign investors suffer currency losses. Import-dependent companies suffer margin pressure. Companies with dollar debt face higher repayment costs. Oil marketing companies face under-recoveries if fuel prices are not passed through fully. Airlines, paints, chemicals, tires, and consumer durable companies may feel pressure from energy and import costs. Domestic institutional investors, or DIIs, have absorbed a large part of the FII selling. This is one of the biggest differences between India today and India in earlier crises. Indian mutual funds, insurance companies, pension money, and retail investors now form a much stronger domestic investor base. That is a major strength. It means foreign selling no longer automatically breaks the Indian market. But it does not mean foreign selling no longer matters. DIIs can cushion the pressure. They cannot completely erase the effect of global capital leaving. A durable rally still becomes harder if foreign money continues to stay away, the rupee continues to weaken, and earnings do not accelerate. That brings us to the comparison with 1991 and 2013. This is not 1991. In 1991, India had only weeks of import cover. The country had to pledge gold. It needed an IMF-backed rescue. The economy was far more fragile, reserves were tiny, and the policy framework was very different. Today, India has hundreds of billions of US dollars in reserves. It has a floating exchange rate, it has a diversified economy, it has strong services exports, it has huge remittances, it has access to global capital markets, it has more policy tools. So calling this another 1991 would be exaggerated. But 2013 is a more useful comparison. In 2013, India faced the taper tantrum. The US Federal Reserve signaled a reduction in liquidity. Capital moved out of emerging markets. The rupee fell sharply. India was placed among the so-called Fragile Five economies because of its current account deficit and external vulnerability. The The 2026 situation is different, but the mechanics have similarities. A widening current account deficit, a weakening rupee, foreign outflows, oil pressure, a need for central bank intervention. The difference is that India's buffers are much stronger today. The current account deficit is far lower than the extreme levels of 2013. Reserves are much larger. Domestic investor support is stronger. But the structural vulnerabilities remain. India still imports most of its oil. India still imports most of its gold. India still has a manufacturing competitiveness gap. India still has an import-heavy consumption pattern. And India is still not a central player in the AI hardware supply chain. That is the core insight. The defenses are stronger. But the vulnerabilities are still there. Services, exports, and remittances help a lot. India's IT and business services generate large foreign exchange earnings. Indian workers abroad send huge amounts of money home. India remains one of the world's largest recipients of remittances. These inflows are crucial. They are one reason India can manage external pressure better than many countries. But they are not unlimited. A large share of remittances comes from West Asia. If geopolitical tensions affect Gulf economies or Indian workers there, that cushion could weaken. IT services are also facing AI disruption fears. India's IT index has struggled, partly because investors worry that AI may pressure traditional outsourcing models. So, services and remittances are a cushion, but not a complete solution. The deeper solution has to be structural. India needs lower energy import dependence. That means domestic energy production where possible, renewable scale-up, battery storage, grid investment, public transport, less oil-intensive growth. India needs stronger export manufacturing, not just assembling imported parts, but building deeper value chains. India needs to move higher in the AI stack, not just using AI, not just hosting data centers, but participating in the hardware, chips, tools, infrastructure, and high-value intellectual property behind AI. India needs to reduce the gap between its growth story and its external account reality. Because global capital does not reward stories forever. It eventually asks where the earnings are. It asks where the productivity is. It asks where the exports are. It asks where the pricing power is. It asks where the next wave of global profits will come from. And right now, the answer in Asia is more likely to be Taiwan, South Korea, and Japan than India. That does not mean India's long-term story is broken. It means the story is being tested. There is a difference. India still has demographics, domestic demand, digital infrastructure, entrepreneurship, and a large internal market. These are real strengths. But the rupee problem shows that domestic strength is not enough if external vulnerabilities keep building. A country can have strong domestic demand and still be exposed to imported energy. It can have high growth and still lose foreign portfolio flows. It can have world-class software talent and still miss the AI hardware boom. It can have large reserves and still face a controlled currency decline. That is the nuance. The rupee is not falling because India has no future. It is falling because the present has become expensive in dollar terms. Oil is expensive. Gold is expensive. Capital is selective. AI has changed the map of global investing, and the middle class is absorbing the cost through a quieter, slower squeeze. So what should ordinary Indians take away from this? Not panic, but awareness. A weak rupee means imported lifestyles become more expensive. Foreign education becomes more expensive. Dollar debt becomes riskier. International travel becomes costlier. Imported gadgets may rise in price. Fuel and food shocks can spread through the household budget. For families, the practical lesson is to protect cash flow. Avoid assuming that EMIs will always remain manageable. Be careful with foreign currency expenses. Build emergency buffers where possible. Understand that gold may protect a household, but at the national level, heavy gold imports worsen dollar demand. For investors, the lesson is also nuanced. A weak rupee can help exporters, IT, pharma, textiles, and remittance-linked households. But it can hurt import-heavy companies, oil marketing companies, airlines, consumer durables, and firms with dollar debt. For policymakers, the lesson is sharper. The rupee is exposing the unfinished work: energy dependence, manufacturing depth, AI hardware participation, export competitiveness, fiscal flexibility, household resilience. These are not election cycle problems. They are decade-long structural problems, and the currency is simply making them visible. The most important point is this: the rupee's fall is not just about the dollar. It is about what India must buy from the world, what India can sell to the world, and where global capital believes the future is being built. As long as India imports most of its energy, imports most of its gold, remains outside the core AI hardware boom, and depends on foreign investors who can rotate elsewhere, the rupee will remain vulnerable whenever global conditions turn hostile. India is not in a 1991 crisis, but it is in a serious moment of exposure. The petrol pump is part of the currency market. The stock market is part of the currency market. Gold buying is part of the currency market. AI investing is part of the currency market, and the middle-class budget is where all of it finally shows up. The rupee problem is bigger than the dollar. It is a mirror. And right now, that mirror is showing India exactly where its growth story is strong, where it is fragile, and where the next big reform question may have to begin.